Forward exchange contracts, or FECs, lock in a foreign exchange rate for settlement at a future date. The locked-in FX rate is referred to as the forward FX rate. This rate is not a forecast, but is a calculated rate based on the current spot rate and the interest rate differential between the terms currency and the base currency. The formula for calculating the forward rate is as follows. With spot being the spot exchange rate, IT is the interest rate of the terms currency, IB is the interest rate of the base currency, D is the days in the period, and Y is the day count convention. The forward rate therefore reflects the future value of the spot rate, and similarly, the spot rate reflects the present value of the forward rate. Forward exchange contracts are used when an organization has a known payment or receipt taking place in the future. They commit the organization to buy or sell the base currency at the forward rate at settlement. This locks in the organization's cash flows, eliminates volatility, and can ensure a satisfactory financial outcome. However, because it locks in the outright rate, the downside is that the organization will not benefit from favorable movements in the exchange rate between now and the forward settlement date. Let's now look at an example. An Australian importer has $1 million New Zealand dollars commitment in 12 months' time. The spot rate is currently Australian to New Zealand dollars of 1.1, equating to a current cost of 909,091 Australian dollars, which is calculated as $1 million New Zealand dollars divided by 1.1. Fluctuations in the exchange rate over the next 12 months will change the Australian dollar cost for the importer as follows. If the exchange rate is 1, the cost will be 1 million Australian dollars. If it is 1.05, it will be 952,381 Australian dollars, and so on. Note how the payment amount decreases as the exchange rate rises. To lock in an Australian dollar amount, the importer could enter into an FEC with a bank to sell Australian dollars and buy $1 million New Zealand dollars at the current 12-month forward rate. Assuming interest rates in New Zealand were 4% and interest rates in Australia, the base currency, were 2%, the forward rate is calculated using the formula as follows. 1.1 is the spot rate, the interest rate of the terms currency is 0.04, the numerator of 365 represents the days in the period, which in this case is a year, the denominator is the day count convention in New Zealand, which is 365. The interest rate of the base currency is 0.02. The day count convention in Australia is also 365. Based on the formula, the forecast rate is therefore calculated as 1.1216. Regardless of the exchange rate fluctuations over the next 12 months, the Australian importer has locked in the AUD cost for the purchase of 891,583, calculated as $1 million New Zealand dollars divided by 1.1216. While this locks in an Australian dollar amount and protects the downside from a falling Australian dollar, it also means that the importer cannot benefit from the rising Australian dollar. As can be noted from the last column in the table, the company will be able to protect itself against rates that are lower than 1.1216, but will not benefit if rates rise above 1.1216. Let us finally consider an example relating to an exporter. An Australian exporter expects to receive $2 million in 3 months' time. The spot rate is currently Australian dollars to US dollars 0.6, equating to a current receipt of 3,333,333 Australian dollars, calculated as $2 million divided by 0.6. Fluctuations in the exchange rate over the next 3 months will change the Australian dollar receipt for the exporter. As an example, if the exchange rate is 0.5, then the receipt will be 4 million Australian dollars. If it is 0.55, the receipts will be 3,636,364 Australian dollars, and so on. Note how the receipt amount decreases as the exchange rate rises. To lock in an Australian dollar amount, the exporter could enter into an FEC with a bank to buy Australian dollars and sell $2 million at the current 3-month forward rate. Assuming interest rates in the US were 1% and interest rates in Australia were 2%, then the forward rate is calculated as follows. 0.6 is a spot rate, the interest rate of the terms currency is 0.01, The numerator of 365 represents the days in the period, which in this case is a year. The denominator is the day count convention in the US, which is 360. The interest rate of the base currency is 0.02. The day count convention in Australia is 365. This results in a forward rate of 0.5985. Regardless of the exchange rate fluctuations over the next 3 months, the Australian exporter has locked in the receipts for the sale of 3,341,688 Australian dollars, calculated by dividing $2 million US by 0.5985. While this locks in an Australian dollar amount and protects the downside from a rising Australian dollar, it also means that the importer cannot benefit from a falling Australian dollar. As can be noted from the last column, the company will be able to protect itself against rates that are higher than 0.5985, but will not benefit if rates decrease below the forward rate. To recap, forwards lock in an amount, rate, and a future settlement date. The FEC therefore effectively eliminates the exposure, both favorable and unfavorable, to future exchange rate movements. It is also important to remember that forward rates are calculated rates, not forecast rates. They are based on the current spot rate as well as the interest rate differential between the two currencies.